Hey, how's it going, YouTube? Dennis here, and today we're going to be taking a look at my dividend investing portfolio that I've been having for a little over 2 years now. So we're going to see kind of how it's doing. We're going to take a look at some of the performances, what's doing really well, maybe what's not doing as hot, and kind of break some stuff down here for you. Maybe help you out as well if you're kind of going through your journey, maybe just getting started, maybe have some questions on, which way to go, how things look. Because one really important thing for me when it came to investing is knowing that what my strategy is today, it might not be what it is in a couple weeks or even a few months later, and it's okay to change up your style, and that's totally okay. So what we're gonna do is hop over here on the computer. As you can see, we're currently using M1 Finance. This is the platform I personally love to use. This is great for dividend investing and just kind of long-term investing in general. If you're somebody who's interested in getting started with an app like this, it's on desktop and mobile. I'll have a link for them in the show notes down below. Supports out the channel greatly, but it also gets you started right away and gives you a little bonus for going through my link. So let me know for you guys if you're interested in knowing more about this stuff. I love talking about M1 Finance, but beyond that, let's kind of break some stuff down with this portfolio. So what I'm going to do is I kind of have two screens here. Let me see if I could zoom in a little bit, maybe not too much. There we go. All right, so that way we can see a little bit clearer. So you can see I nicely named this Dividend Dennis, although I do have growth stocks in here, and they're becoming a little bit more prominent in the portfolio as things progress. And like I told you guys earlier, sometimes that's a case with this. So as of currently, right now, the value of this portfolio is sitting at $29,280. This is by far the highest the portfolio has ever been. Really excited about that because just a couple months ago, we were sitting at 15,000, which was a huge milestone too. And it's just really cool. So if you see this value over time chart right here, for a lot of people, I like to point this out. I started off with $100 in this portfolio, and I just started slowly, gradually investing more and more into it. Now, for other people who are maybe kind of interested while we're talking about this, I do have retirement accounts as well and some other portfolios, but this is kind of like the one I've been focusing on for, maybe the next 15 years as far as being able to utilize it. But yeah, so you could see this portfolio just growing, and then, like I said, I was about $15,000 in back in November. So in about, what is that, 5 months, I'm nearly doubling the amount of money in here. Obviously, with me putting more in and also the growth in the portfolio too. So you can take a look at that with the growth because I'm pushing all these buttons. So we can kind of backtrack here. So let's go for the last day. Last day was really good in the portfolio. We gained $334. The fun part is as you keep gaining more in your portfolio as far as deposits and growth and everything, this percentage, even if it's a small percentage, will start having a larger and larger impact on your actual gains, right? So like 1.16% now equals out to $334 in my portfolio, but half a year ago, a couple of years ago, 1% might not have really, earned me that much more. So it's really cool that even when the market's like having a slightly good day or a slightly bad day, the impact that small amount can actually, or that small percentage can actually have is pretty crazy, to be honest. So if we go to the last week, we can see we're up about $884 here. In the last month, we're up $2,600, which is really cool because in March we had kind of like a little bit of a dip there. And when we had the dip, I was buying more. I actually increased the amount that I was depositing during that time because for me, when things are in the red, I tend to buy more. And when things are, in the green for a long time, I slow down on how much I'm buying. So a lot of times you'll hear people talk about that. It's being cash heavy. And then let's take a look here. So last quarter, we're up about $1,500 again because of that dip that we had in March. So if we look at the last year, we're up $5,735. Now, this is total money weighted return, which essentially means if I sold some stocks, which I have in the past, and or also earned dividends, which I have, all that is accumulated into this total. Some people don't like that. They prefer the unrealized gains, but there's something to this as well because I'm like, hey, with all the money I've ever deposited into this account, if I were to sell everything today, plus all the things I've sold in the past, that's how much I would have walked away with in total in the last 2 years. Now, granted, with the amount that you saw before, we were only starting off with that $100. So it's relative to the person, not necessarily to the dollar amount, because someone's like, oh, for having $29,000 in there, that maybe could have been a higher growth percentage or a higher dollar amount. But if I put a majority of this 29,000 in the last couple of months, that does also play a factor into it as well. So just something to consider too. Don't ever look at somebody else's numbers and think you're not doing good just because maybe they are. Obviously, different stocks, different amount of money you're putting in, the timing of that as well too. Not that you want to time the market, but if you bought in during a big dip, you might have a much better return versus if you bought at a high and then there's a dip going on and, maybe your numbers aren't looking as good. But either way, if you're in it for the long term, don't worry too much about those kind of things. For those people who do prefer to know unrealized gains, we're up here. So right now, if I sold my total portfolio, it is worth $4,472, which is about 18%. So not too shabby there. I'm not somebody who's like crazy high growth or, whatnot. I try to be conservative in some areas. I do have a little bit more risky stuff when it comes to other portfolios where I'm okay with risking some of that for different types of gains overall, but nonetheless, pretty cool. So one of the things I really wanted to kind of go over is the best type of strategy for investing for beginners. Obviously, if you've been investing for a long time too, you might agree with this or you might not. And I would actually like to hear from you guys in the comments down below too, because when I started my portfolio, let's go to my activities here. And in my date range, this is what I personally liked to do. And this was buying into a ETF. So ETFs are a group of funds put together. This one right here in particular was a great one to get started with. It's ticker number VOO. It essentially just follows the S&P 500. And it's pretty much a very safe bet when it comes to investing. And I really, really like this. I actually have it also in my retirement account as well too. And that's what I got started with. I did a few, obviously, individual stocks like Tesla and Microsoft back in the day. But the big thing was I wanted to make sure that I had a good solid base to get started with. So that's what I invested with for a long time. And more recently, actually, I got rid of my ETFs in this portfolio and are just strictly individual stocks in here. Because, like I said, I have other portfolios that are a little bit more structured for security long term. And so this gives me a little bit more freedom to do things. But for a beginner investor, that's honestly a great way to go, just because I think it's something that can help you kind of get off on the right foot, and then you can change things up over time. Like, yes, you will get stuck with, some tax implications for selling things for a profit and all these other things that come along with it. But at the end of the day, I always tell people it's best to get started and figure things out and move along rather than trying to study everything and then finally get into the market, because being in the stock market like we are here, when we started, we put in that $100, and you can see here, I didn't put a lot of money as I was getting started. I was just trying to figure out, which way this was going, but I was intentional with having money go in. I think I was doing like $10 a week, and then I bumped it up to 20, 30, 40, 50. Now we're around $300 to $400 a week. But that's mainly because we are making sure that we weren't just going in, with all this extra money and then not knowing what we were doing. So that's personally my take on that portion of it too. But what we can see here is these are the different slices that we have here in our portfolio. Let me just make sure everything is on screen here for you guys. I believe it is, yeah. So we have like our tech pie right here, which you can see. Don't worry about the percentages because the percentages here are a little weird, but like total gains in our tech pie, we're up about 1,100. Our growth is about 1,300. Retail right here is about $700, a little over 700. Industries and energy were up about 380. Finance were actually up quite a bit here. You can see here, I don't know, I'm crossing those off still. $1,200. So finance was a really good market for me or sector to be in, especially during the crash in 2020. I definitely started buying it quite a bit heavier into them. I think Discover is my best performing stock in my overall portfolio. I'll double check that. And then you can see here, we got real estate, we're up about $248, and then health, we're up about $129. So I still have a little bit of diversification with these two. And then obviously I'm much more heavier with tech and growth. Our growth pie here is pretty much like tech stocks, but I just wanted to keep them in a separate little group. So we got like Tesla, Amazon, Google, and Facebook all in here. Obviously, Tesla is still doing pretty solid here amongst the rest. Amazon was flat for a long time and then finally started picking back up. So let's go back into our holdings here. Let's see our best performing. Yeah, so Discover is actually percentage wise, obviously not dollar wise because I didn't have as much as I do in Tesla, but percentage wise, it's my best performer. I'm up 91% on it. Obviously, there's people out there that do a lot better with a lot more returns, but they obviously have a higher risk tolerance. I'm just steady as they go, long-term investing, making sure that I'm prepping for dividends as well too, so that way in about 14 years I can use that money to travel, to go do whatever I want. Travel is kind of like the big one for me personally, but yeah, so I'm investing in that. Then obviously Tesla's next up with 50, almost 59%, and then we got Ally. So you could see these two were in the financial pies, and they are, or financial pie, I only got one, but it's doing pretty well across the board there. So I'm really excited for that. I think it has a lot of potential. If we go to seekingalpha.com here, make sure it's all on screen. So this is my portfolio, and then I can see with performance in like the last 5 days what's done really good. Like we've got Google, Square, Facebook, Microsoft, all of these on my portfolio are doing really well. In that last 5 days, Airbnb has still been taking a hit, which is fine because like I told you guys earlier, I love to dollar cost average when it's red. So sometimes when the whole pie is down, like the whole portfolio is down, I'll just invest a bunch more. When just one or two stocks are individually down for a while, I'll like buy in to just that one stock for a while. So for a little bit, we had a couple different stocks that were down for a good while. It was Costco, Home Depot, Lockheed Martin, and DLR, which is Digital Realty Trust, were all down pretty heavy on my portfolio. Obviously, it could be different for yours, but they were down for a little while in my portfolio. So I just kept buying more into them, dollar cost averaging, bringing my total cost down. And then the nice thing is all of them have recovered, which is great, but also not at the same time. It's great because, now it doesn't look red in my portfolio. Like when I look at these, let me go by name here so I can find it quicker. So like Lockheed Martin was one. So right here, you can see we're up about 8.5 or 8.7%. For me, I'm like, hey, that's nice looking, but like 3-4 months ago, this thing was in the red for me. So every time I bought, my average cost went down. So like you could see average price for me is $355. And I think this stock was, let's see how low it went. That way we can kind of get an idea here. See, I'll have that load up here. So like so January was at its lowest point, which was give or take about $321. So I was buying in at that time still. And so, you can see that my average definitely had gone down significantly every time I bought more in, because my average still now is $355, even though it was as low as $321. So I kept buying in, and now it's in the green. So I slowed down on buying more. Not that I'm not going to continue to buy more, but my focus now is usually on whatever is currently red or very close to being red. So Airbnb and Etsy, you can see here, Airbnb, I'm down about 7%. Not too worried about it because, again, it's long term. And I do know, for those who are watching, it is not a dividend paying stock. But I believe that long term, a lot of these companies end up becoming dividend paying stocks. So if I own them now and, in 10, 15 years, they decide to start paying out dividends, well, guess who already owns the stock, and guess who's going to have an amazing yield on cost? Me, this guy. So I think it's really exciting. I'll show you here. I used this example last time, and I just think it's helpful because a lot of people know Apple, right? So Apple pays a dividend, and it's a very low dividend yield. Like if you're a big focused dividend investor, you probably have a lot of people talking about how this is only 0.64%. So it's not even 1%. And a lot of dividend investors focus on that 4% rule, which I don't focus on personally. So if you care more about the 4% yield now, I'm not your guy. I'm actually more of the longer term dividend focused person because I care about dividend growth more so than the current dividend yield. And the reason for that is because it's twofold. One, is it twofold? I guess it's just onefold. I don't know. But the main thing is that I don't need my dividends now. I need them for later, right? I want them for 14, 15 years from now. So for me, when I'm getting these dividends now, I have to pay taxes on them, right? And depending on your income and everything else, it could be a decent amount of taxes that you have to owe, which is not the biggest deal in the world. But at the same time, I'm like, okay, why would I want to pay taxes on something I'm getting back right now for 4% versus getting something for like 2% yield? And then it has nice growth over time. And I'll maybe show you guys that if I can recall. Sometimes I say something and then I forget to like show you guys. But going over with this example, so the current yield on Apple is 0.64. We're going to go to the dividend yield here. This is what I really, really like about this. So they have this thing called yield on cost. So effectively, whatever price point you're buying into a stock now, that is your yield on cost. And if the stock raises their dividend throughout the years, your yield on cost actually goes up, which is really good. That means you're making more money for having put less than what you need now, or I kind of messed that up a little bit. The way it works is dividend increases come in, and now you're making more money for having put no extra money into the portfolio, which means that your yield actually moves forward. So I'll show that here. This is current times, and this is 5 years ago. So buying into the Apple stock now gets you 0.64. If you bought in 5 years ago, let's say you didn't buy or sell exactly 5 years ago, your yield on cost would be 3%. But 5 years ago, it wasn't a 3% yield. I don't really know what it was exactly, but it was probably closer to like 1 to 2%. But it keeps increasing their dividends, which is Apple, every year. So that's a really nice thing. But here's a really cool thing. Apple didn't start paying out a dividend until 2012. I think you can kind of see it here on the chart. 2012 was the first year they paid out a dividend. Oh, you can even see. The year ended about like a 1% yield, right? So not a lot. So check this out. So if we go to our max. Now, before we continue on, if you are somebody who needs to refinance their student loans because maybe you are paying a little too much in your interest, check out my friends Earnest. I'll have a link for them in the show notes down below. They will help you refinance your student loans entirely for free. And it takes only about 2 minutes to check out your rates and can honestly save you thousands of dollars. And you can use that money to invest more into the stock market or extra money into your pocket every single month. And again, I'll have that link in the show notes down below so you can go ahead and refinance your student loans. It's going to be a really big chart here for a second. So 2012 is when you started getting out a yield for it. So give or take, let's say, I don't know when exactly they paid it, but let's say you bought it right here. Your yield on cost would be 4%. That's really good. That's the goal that people want, 4%. But you would have had to buy that back in 2012. But for people who were buying into Apple not knowing that they were going to pay a dividend or didn't care for the dividend, like let's say in 2008, especially during that crash, check this out. So the yield on cost on this, 23%. So if you're buying Apple stock back then, not only you had amazing growth over these last couple of years, especially if you didn't, keep buying in, because if you kept buying in, that yield goes down a little bit. But let's say you bought in, $10,000, $100,000 back then, you'd have all that amazing growth, and now you're getting 23% on your money. So whatever you put in, you're getting 23% back a year. That's incredible. And then you could look, it gets even crazier, like 2003. You'd get 343% back on your money. But that's, when people were buying it back then, did Apple pay dividends back then? I think at one point they might have, but regardless, in 2003, let's just say they didn't pay any dividends. I mean, the expectation wasn't there, but look at that. Can you imagine getting 343% yield on cost? That would be nuts. And up here, it's what, 690, 500 and something crazy. And if you bought it back in 91, your yield on cost would be 134%, which is still not bad, plus all that amazing growth that you'd be getting. But the point of that is that, yes, companies like Airbnb, Etsy, and I even got like Amazon and some of these other companies that like Squared, they don't pay a dividend right now, but maybe in 15 years, maybe in 20 years, maybe they do. Who knows? My expectation is that these companies are going to grow pretty healthy, and if they don't pay out dividends when I start wanting dividends, I could sell them and then put them into stocks that are paying 4% at that point, because then I'm getting the 4%. Or, hey, if Square in 15 years is like, hey, we're going to start paying out a dividend, and whatever my yield on cost is, because right now I only own 3 shares, but in 15 years, I don't know, that could be 300 shares. And then I'm getting a nice little, deposit every quarter with this money. And I'm like, I like it. Why not? Why not have that? But that's the way I see it. That's the way I think it's going to go for me. I don't think every company is going to do it. I'm really considering if Tesla will ever pay out dividends. I don't really see that happening, but it can. Who knows? Maybe they get to a point in like 15 years that they can. Same thing with Amazon and Google and Facebook. Maybe in the future that at some point they can probably do something like that as well too, because that'll be really cool. But I think for a lot of people, if you're like myself, this stuff has changed a lot. Like for me, actually even more recently, and I don't do this very often. I don't like to sell too much, but I recently sold out of Aflac to just focus in on a little bit more of the financial stocks because I had too many, and then because I had 5 in that sector and I just wanted to be down to 4. And then before that, where was it? I did another sell recently, right over here, March 22nd. So I sold out of Pepsi, Realty Income, AT&T, Procter & Gamble, and SPYG, which was that index fund I had, and I put them more focused on the rest of my stocks. But besides that, it's been a long time. I don't know if I can see. I don't know if I could see just the sells, because besides these 2 sells right here, which knocked me down to just 24 holdings total, I almost never. You can see all my buys and stuff like that kind of thing here. Like I just never sell. Like I sold here. I was just kind of moving some stuff around, and then yeah, like it's pretty much almost all buys here. Like there's nothing for months on end. There was a sell right here. What did I sell? I switched from one ETF to another. But that's just my thing, is like I'm trying not to sell too much, but also I'm trying to build up a portfolio that I like. Try to keep my holdings to a minimum of 24 right now, which sometimes I feel like is a lot, because then when I deposit, $300-400, not all that money goes to all of these stocks, right? So if I go to my activities back here, what was the last time I did So I did like a $300 deposit here back in April. So you could see here, so $300 buys into 12 stocks. We had like NRZ, Johnson & Johnson, Airbnb, Ross, Costco, Apple, Etsy, Home Depot, Amazon. So like a little bit into all of these companies, but that's only half of the stocks that I own. So, I mean, it's not M1 Finance or anything else. It's just, the amount of money that I have, and I can only buy so much of each company. Yes, I could, have each stock have like $5 go into them, and then a few stocks get a little bit more than that. But I want to get to a point where 24 is a lot to like manage, as far as keeping up with the news, checking out what's going on with the books, making sure that the CEOs are on the right track with things, making sure that there's no bad publicity, all these different things. So keeping up with these companies is more than enough for me personally. I don't know if I would sell more at this point. I really like the stocks that I own. You can kind of see a good chunk of them. Obviously, well, that's 12 of them, so that's half. But you can see pretty much all of them from right here if you wanted to see them. I think there's 2 more at the bottom you can't see from the screen because of... Let me see if I could do this. No, that makes it worse, actually. Let me see if I could zoom in. So we got... I'm like screwing this up. Hold on. Yeah, you can't see it at the bottom. So you can barely see Etsy down here. And then right underneath Etsy, there's one more, which is Texas Instruments. So those are pretty much all my stocks there. You guys can see them. I have Apple is like my biggest holding, and Microsoft my next biggest. Then we got Tesla, Amazon. But funny enough, 2 out of the 4 at the very top don't pay any dividends. And then the top 2 pay very low yields. Very, very low yields. But again, it's all for long term. Dividend growth is going to be a big thing, right? So the reason how like this yield on cost keeps going up is because companies like Apple, if I go here, raise their dividend yields, or dividend payouts, I should say, and that yield goes up. So let me go here. So dividend news. So we can see here. So like back in, what was this? April of 2020. So this was a year ago. So hopefully this year they're going to have a good increase. They increased their dividend by 6.5%, which doesn't sound like a lot, but hey, that's a really good raise. I mean, I would think most people would be happy to get a 6.5% raise from their jobs, but depending on how many stocks you own, that could be a healthy amount. So you saw we own about 30 shares. So let me bring up a calculator here. So let's say they do another, let's just show if we had the 30 shares beforehand. So 30 shares at 77 cents would be $23.10. And then at 82 cents a share times 30, that's 24.60. What did I say before? Was that 23.10? So that's $1.50 that we got more because we own those 30 shares. Doesn't seem like a lot, and I know it's not a lot, honestly. But that's $1.50 per quarter. So then if you times that by 4, that's an extra $6 a year. I mean, $6 a year extra. I mean, I wouldn't complain about that. But then just imagine if we had 300 shares or 3,000 shares, or crazy numbers like that, where over time those increases start having a really, really big impact, like huge impacts on where our income's going to come from in about 15 years. Because sure, some companies can do 6.5%. Sometimes companies we have do 10, 14% yield increases, which is really cool, right? Like having that kind of increase is really nice. It's really healthy for us. Let's see. I think it was like Lockheed Martin here. I'll take a look at them really quick. We can check this out. So they did 8.5% yield increase. So they went from $2.40 per share to $2.60. So that's 20 more cents per share. I own, I think you saw it was about 3 shares there. So that's 60 more cents per quarter. So that's going to be a healthy amount extra. But again, if you have even more, that's a bigger increase. That's more money coming into your pocket. And that's less you've had to buy from that stock to be able to get that payout as well too. So I think it's really cool. I personally love it. I think focusing on this path might be the best option for me. Obviously, you guys can follow along by subscribing down below, because that will show you guys, where we're going with this portfolio. A lot of people have been following for a while now to see how it's growing, because I think that's a cool thing, is seeing people grow in their portfolios, how they change up their style. Because this is all I do with this channel, is just show you guys my investing strategies. And I do different platforms and different strategies with each one. So we'll see how each one performs, which one might do best long term. You guys can find that out. But hit that like button down for me below, because that does help support out the channel as well. Like I mentioned, I'll have the links in the show notes if you guys are interested in checking out M1 Finance or any of the other stocks or websites that I use that I have linked down below. Those things actually really support me out in the channel tremendously amounts. But for you, I think it's always great to keep on learning and growing. So checking out my next video right up here, I can't even talk. The next video right up here, you guys can keep on learning and growing with me. So see you guys in that next video.